नमस्कार बच्चों, हम क्लास 11 के पहले 6 लेक्चर्स कंप्लीट कर चुके हैं और इन पहले 6 लेक्चर्स में हमने 2 चैप्टर कवर किए हैं। चैप्टर नंबर 1 है आपका इंट्रोडक्शन टू अकाउंटिंग एंड चैप्टर नंबर 2 है बेसिक अकाउंटिंग टर्म्स। ये दोनों चैप्टर बेटा कंप्लीट हो चुके हैं पहले 6 लेक्चर में। आज है लेक्चर नंबर 7 और इस लेक्चर में हम स्टार्ट करेंगे थर्ड चैप्टर अपने अकाउंट्स का, अकाउंटिंग प्रिंसिपल्स। लेकिन इस चैप्टर को पहले आप स्लाइड से एंड एनिमेशन से समझेंगे। जो लेक्चर नंबर 8 होगा मैं इस चैप्टर को पूरा फिर खुद से आपके साथ डिस्कस करूंगा। तो इस लेक्चर में जो भी ये चैप्टर है इसको पहले आप स्लाइड से अच्छे तरीके से समझिए, एनिमेशन से अच्छे तरीके से समझिए। और ये चैप्टर बहुत ही इंपॉर्टेंट चैप्टर है जो कि आपका पूरे अकाउंट्स का बेस बनाता है। पहले तो आपने एबीसी सीखी, अब आप सीखेंगे अकाउंटिंग प्रिंसिपल्स। मतलब क्या क्या प्रिंसिपल्स यूज किए जाते हैं अकाउंटिंग करते समय। हमें कुछ कॉन्सेप्ट्स फॉलो करने होते हैं, कुछ कन्वेंशंस फॉलो करनी होती हैं जो कि इस चैप्टर में हम सीखेंगे। लेकिन उसको पहले आप स्लाइड से समझेंगे, फिर उसके बाद नेक्स्ट लेक्चर में मैं खुद से आपको उसको एक्सप्लेन भी करूंगा। तो आप देखना स्टार्ट कीजिए।
Persons or parties who are interested in the financial statement of a business. The financial statements of a business are useful for various parties such as investors, government, creditors. Financial statements disclose the profitability and solvency position of the business to various parties. It is therefore necessary that these statements should be prepared according to some set rules and standard language. Financial statements are thus prepared using rules and procedures called GAPs. Generally accepted accounting principles, GAPs, are the basic rules which have been generally accepted by accountants all over the world as general guidelines for preparing the accounting statements. GAPs have been formulated so that the financial statements are drawn on uniform basis. According to the American Institute of Certified Public Accountants, principles of accounting are the general law or rule adopted or proposed as a guide to action, a settled ground or basis of conduct or practice.
Let's understand the significance of accounting principles. Accounting information is meaningful and useful only if the accounting records and financial statements are prepared by the following GAPs. Accounting principles bring uniformity and consistency to the process of accounting. Accounting principles help to compare the accounting information of a firm with the other firm and with the previous year.
Let's test your knowledge. Choose the correct answer. Accounting principles help to bring A. Uniformity, B. Comparison, C. Both uniformity and comparison.
Features of accounting principles. Accounting principles are man-made. Accounting principles are derived from practical experiences and reasons. They are not tested in laboratories like the principles of natural science, hence they lack universal applicability. Accounting principles are recommended for use by all enterprises to ensure uniformity and understandability. Accounting principles are flexible. Accounting principles are not rigid and may change with the passage of time in response to the changes in business practices, government policies, and needs of the users of accounting information. Accounting principles are generally accepted. General acceptance of accounting principle usually depends upon how it meets the following 3 criteria. Relevance. A principle is relevant if it results in information that is useful to the user of the accounting information. Objectivity. A principle is objective if it is not influenced by the personal bias of the persons who furnish the information. Feasibility. A principle is feasible if it can be applied without undue complexity or cost.
Features of accounting principles. Accounting principles are man-made. They are made by humans and are based upon practical experiences. These principles lack universal applicability but are recommended for use by all enterprises to ensure uniformity and understandability. Accounting principles are flexible. Accounting principles may change with the passage of time in response to the changes in business practices, government policies, and needs of the users of accounting information. Accounting principles are generally accepted. Accounting principles form the base and guide for accounting and are generally accepted. The general acceptance of accounting principles usually depends upon how they meet the criteria of relevance, objectivity, and feasibility.
Accounting principles include accounting concepts, accounting conventions. Accounting concepts. Accounting concepts. Features. Accounting concepts are the basic assumptions within which accounting operates. Accounting concepts are the generally accepted accounting rules based on which transactions are recorded and financial statements are prepared. Accounting concepts guide how transactions should be recorded and reported. Accounting concepts are important since they enable the users of financial statements to understand the financial statements better. Following are the accounting concepts: business entity concept, money measurement concept, going concern concept, accounting period concept, historical cost concept, dual aspect concept, revenue recognition concept, matching concept, and objectivity concept. Let us understand the business entity concept with the help of an animation.
Mr. Jagat Singh took a building on rent. Rent is fixed at the rate of ₹4,000 per month. He started a business investing ₹1 lakh, out of which ₹50,000 has been taken as a loan from State Bank of India. Half of the same building is being used for his residence. Monu is the son of Mr. Jagat and studies in 3rd class. His school fees of ₹1,000 per month is paid out of the business funds. After 1 year, Mr. Jagat calculated his profits earned through the business. Total sales during the year ₹1,20,000. Total purchases ₹50,000. Total rent paid ₹48,000. Total fees paid ₹12,000. Now, total income is ₹1,20,000. Total expenditure ₹1,10,000. Thus, total profits ₹10,000. Mr. Jagat also showed his financial position at the end of the year as liabilities. Loan from State Bank of India of ₹50,000. Assets worth ₹1,10,000. Do you think he is right? No, certainly not. Complete rent for the building cannot be charged to business because full building was not used for the business. Similarly, his ward's fees is not a business expense. Though Jagat is the sole owner of the business and there is no separate legal existence of the business, still, as per accounting point of view, the owner of the business and the business are two separate entities. No personal expense can be included in the business expenses. Expenses made for personal or domestic use are personal expenses. Half of rent, rupees 2000, is his personal expense. His wards fee, rupees 1000 per month, is his personal expense. Amount taken from bank is a loan. Similarly, the balance amount of rupees 50,000 invested by owner himself is also a liability for the business and called capital. Amount withdrawn for personal use is known as drawing and will be shown by way of deduction from capital. Amount of profit is a reward for the businessman and will be shown as an addition to the capital. Corrected information. Now, business entity concept or separate entity concept can be summarized as: business and businessmen are separate entities. Transactions are recorded in the books from the business point of view and not from owner's point of view. Personal expenses or incomes are not recorded in the business books. Amount introduced by owner is a liability to the business and called capital. Amount withdrawn or expended for personal expenses is called drawing and deducted out of capital.
Business entity concept. According to this concept, business is considered separate and distinct from its owners. Business transactions are recorded from the business point of view and not from the owner's point of view. Capital is treated as liability of the firm by assuming that the firm has borrowed funds from its owners. Business entity concept applies to every form of enterprise, including proprietorship firms. Let us understand business entity concept with the help of an example. What will happen in the absence of business entity concept? In the absence of this concept, affairs of the firm will be mixed up with private affairs of the entrepreneur. For example, if household expenses of proprietor, rupees 10,000, are shown as business expenses, the profits of the business will be underestimated to the extent of rupees 10,000. Money measurement concept. According to money measurement concept, only those transactions that can be expressed in terms of money are recorded in the books of accounts. An important event cannot be recorded if it cannot be expressed in monetary terms. For example, sincerity, loyalty, and honesty of employees are not recorded in the books of accounts because these cannot be measured in terms of money, although they do affect the profits and losses of the business concern. Let us understand money measurement concept with the help of an example. What will happen in the absence of money measurement concept? In the absence of this concept, it will be difficult to understand the accounts prepared by the business enterprises. No guidance will be available regarding what to record and what not to record. In the absence of money measurement concept, there will be difficulty in comparison of business performance. Going concern concept. According to going concern concept, it is assumed that the business will continue to exist for a long period in future and that there is no intention to close the business or reduce its operations. This concept facilitates preparation of financial statements. Going concern concept assures investors that they will continue to get income on their investments. A business is judged for its capacity to earn profits in future. Let us understand going concern concept with the help of an example. What will happen in the absence of going concern concept? No outside party will enter into long-term contract with business. In the absence of this concept, no distinction can be made between current assets and fixed assets and current liabilities and long-term loans.
Let us recapitulate the various accounting concepts we have studied. Business entity concept. According to this concept, business is considered as a separate and distinct entity. Its owners are treated as creditors of the business. Money measurement concept. According to this concept, only those transactions and events that can be measured in money terms are recorded in the books of accounts of the enterprise. Going concern concept. According to this concept, it is assumed that business shall continue for a foreseeable period and there is no intention to close the business or scale down its operations.
Accounting period concept. According to accounting period concept, life of a business is broken into smaller periods, usually 1 year, so that its performance can be measured at regular intervals. According to the going concern concept, performance of a business could be measured only at the time the business is completely wound up. However, it will be of little use to the owners, investors, etc. To take the decisions at the appropriate time, it is required to furnish the financial statements or performance of the company at regular intervals. What is the significance of accounting period concept? Accounting period concept help banks, financial institutions, creditors, etc. to assess and analyze the performance of business for a particular period. It helps the business firms to distribute their income at regular intervals as dividends. Accounting period concept helps in computing tax on business income. Let's test your knowledge. Choose the correct answer. Proprietor of the business is treated as a creditor of the business as per A. Business entity concept, B. Going concern concept, or C. Accounting period concept. Historical cost concept. Historical cost concept states that all assets of an enterprise are recorded in the books of accounts at their purchase value. It holds that an asset is recorded in the books at the price paid to acquire it, and the cost is the basis for the subsequent accounting of the asset. Market value of an asset may change, but in the books of accounts, it will be shown at its book value, purchase cost, less depreciation. For example, an enterprise purchased building for rupees 5 lakhs. After 2 years, its value increased to rupees 10 lakhs, but it will be shown in the books at rupees 5 lakh only. Let us understand historical cost concept with the help of an example. What is the significance of historical cost concept? Value of assets can be verified from the supporting documents as assets are recorded at that price only. The effect of cost concept is that if the business entity does not pay anything for an asset, this item will not be shown in the books of accounts. Dual aspect concept. Every business transaction has two aspects, a debit and a credit of equal amount. Due to this principle, debit and credit of trial balance become equal and the balance sheet always tally. Assets is equal to capital plus liabilities. For example, goods purchased for cash has two aspects, giving of cash and receiving of goods. For example, capital brought in by the owner of the business has two aspects. 1. Receipt of cash, and 2. Increase in capital, that is, owner's equity. Let us understand dual aspect concept with the help of an example. What is the significance of dual aspect concept? Dual aspect concept help accountants in detecting errors. This concept encourages accountants to post each entry in opposite sides of two affected accounts.
Let us recapitulate the various accounting concepts we have studied. Accounting period concept. According to this concept, life of an enterprise is broken into smaller periods so that its performance is measured at regular intervals and reported to interested parties. Historical cost concept. According to this concept, an asset is recorded in the books of accounts at the price paid to acquire it. It is not recorded at market value because market value of an asset may change with the passage of time. Dual aspect concept. According to this concept, every transaction entered into by an enterprise has two aspects, a debit and a credit of equal amount.
Revenue recognition concept. Revenue recognition concept states that revenue should be treated as realized whenever the ownership of goods changes. It is immaterial whether the revenue is received in cash or not. For example, an enterprise sells goods in March 2011 and receives the cash in May 2011. Revenue of these sales should be recognized in March 2011, that is, when the goods are sold. Let us understand revenue recognition concept with the help of an example. Matching concept. As per the matching concept, cost of a particular period should be charged from the revenue of same period only. Only such matching of cost and revenue can reveal the actual profit or loss of a period. When cost is matched to particular product or service, revenue earned from that product or service should be matched to its cost. As per the matching concept, the following things should be taken into account while ascertaining profit or loss of that year. All revenues are earned during an accounting year, regardless of the fact that whether they have been received in that year or not. All costs are incurred during an accounting year, whether paid during the year or not. For example, revenues of a period, rupees 15 lakh, are matched with the expenses, rupees 11 lakh of the same period to find the profit, that is, 15 lakh minus 11 lakh of the period. What is the significance of this concept? Matching concept guides how the expenses should be matched with revenue for determining exact profit or loss for a particular period. Matching concept is helpful for the investors or shareholders to know the exact amount of profit or loss of the business. Objectivity concept. This concept states that accounting data should be definite, verifiable, and free from personal bias of the accountant. Transactions are recorded on the basis of vouchers, receipts, cash memos, and the like. As per objectivity concept, each transaction in the books of accounts should have an adequate evidence to support it. Let's check your knowledge. Choose the correct answer. Transactions should be supported by adequate documents as per A. Revenue recognition concept, B. Dual aspect concept, or C. Objectivity concept.
Let us recapitulate the various accounting concepts we have studied. Revenue recognition concept. According to this concept, revenue is considered to have been realized when a transaction has been entered into and the obligation to receive the amount has been established. Matching concept. According to this concept, cost incurred to earn revenue is recognized as expense in the period in which related revenue is recognized as earned. Objectivity concept. According to this concept, all accounting transactions should be evidenced and supported by business documents such as cash memo, invoices, and sales bills.
Accounting conventions. Accounting conventions. Accounting conventions refer to customs or generally accepted practices which are adopted either by general agreement or by common consent among accountants. Accounting conventions differ from accounting concepts in the following respect. Accounting concepts are established by law, whereas accounting conventions are guidelines based upon custom or general agreement. Accounting concepts are adopted uniformly in different enterprises, while it may not be in case of accounting conventions. Following are the main accounting conventions: Convention of Full Disclosure, Convention of Consistency, Convention of Conservatism, Convention of Materiality, Convention of Full Disclosure. Convention of Full Disclosure states that accounts should be prepared in such a way that all material information required by the users of financial statements is clearly disclosed. For example, a claim of big amount pending in a court of law against business should be brought to the notice of the users of financial statements. Note: disclosure of material facts does not mean to leak out the secrets of the business, but to disclose sufficient information which is of material interest to the users of financial statements. Let us better understand Convention of Full Disclosure with the help of an example. Convention of consistency. According to convention of consistency, accounting principles and methods should remain consistent from one year to another. This convention helps in understanding the accounting information more clearly and makes it comparable with that of previous years. Accounting practice and methods once applied may be changed if the change will result in more meaningful presentation. If a business desires to adopt an alternative practice, it must disclose the change and its impact on the profit or loss. Let us understand convention of consistency more clearly. Convention of conservatism. According to convention of conservatism, all anticipated losses should be recorded in the books of accounts, but all anticipated or unrealized gains should be ignored. Provision is made for all known liabilities and losses, even though their accurate amount cannot be determined with certainty. For example, closing stock is valued at cost price or realizable value, whichever is less. Creation of provision for doubtful debts. Convention of materiality. According to convention of materiality, a transaction should be regarded as material if there is a reason to believe that knowledge of it would influence the decision of an informed investor. Only those items that have significant effect should be disclosed. Whether an item is material or not depends on its nature or amount and also on personal judgment. Note: an item which is material for one concern may be immaterial for another. For example, tools may be material for a small repair workshop but may be immaterial for a big auto company. Let us understand the convention of materiality more clearly.
Accounting conventions. Accounting conventions refer to customs or generally accepted practices which are adopted either by general agreement or by common consent among accountants. Convention of full disclosure. As per this convention, all significant information relating to economic affairs of the enterprise should be completely disclosed. Convention of consistency. As per this convention, all accounting methods or principles should be consistent year after year to determine the profitability and to know the position of assets and liabilities. Convention of conservatism. According to this convention, all anticipated losses should be recorded in the books of accounts, but all anticipated or unrealized gains should be ignored. Convention of materiality. As per this convention, items having an insignificant effect or being irrelevant to the user's need not be disclosed.
Let's test your knowledge. Choose the correct answer. Convention of conservatism takes into account A. all future profits but not the losses, B. all future profits and losses, or C. all future losses but not the profits.